Hey, what's going on, guys? Stock market reached another new all-time high just recently, but other fundamental indicators may signal that this economic expansion is about to come to the end. In this video, I would like to take a look at two very important indicators, which are eurodollar and unemployment rate. This video is brought to you by Young Hustler. Those guys actually reached out to me and brought the eurodollar chart to my attention. Those guys offer super simple trade alerts for beginner traders for just $10 a month. It's a great value. And also free stock market updates. If you make it to the end of this video, I will tell you how you can get 90% discount code for their products. First, let's take a quick look at the stock market. S&P 500 reached new all-time high just recently, tapping below $3,400 a share. Since the beginning of this new year, January 2020, S&P 500 gained close to 200 points, or almost 6%. I would like to point out that in 2019, corporate earnings did not really increase at all, while S&P 500 increased by close to 30%, which may mean that the stock market is artificially pumped by cheap money for no reason and possibly forming a bubble. Let's take a closer look at eurodollar indicator. On the bottom, we have S&P 500 since late 1990s, and on the top, we have eurodollar chart. What is very interesting is that when stock markets start declining, eurodollar chart has some major spikes. Let's take a look at 2000s dot-com bubble, for example. Stock market was going up like crazy. At the peak, S&P 500 reached up to $1,500 a share. This is when Federal Reserve increased interest rates up to 6.5%. When they realized they were in trouble, they drastically started dropping interest rates, while S&P 500 was dropping as well. This is when we entered into the bear market. During those 2 or 3 years, S&P 500 dropped from $1,500 to $750, and that's about 50% drop, while interest rates dropped from 6.5% to 1.5%. But let's take a quick look what happened to eurodollar chart. At the peak of 2000s dot-com bubble, eurodollar was slowly descending. But there is something interesting about eurodollar chart that is different from any other charts. There is a point where it stopped going down. It's showed by this yellow arrow. After it dropped, it raised slightly, then it went to this very tight trading range, which is indicated by this red arrow. Then exploded upwards while S&P 500 was on the edge of dropping further. This was the indication that the bull market is over and the new bear market has begun. In 2003, we reached the bottom of the bear market and eurodollar became flat and continued to consolidate sideways while we enter into new bull market. Let's take a look what happened in 2008 housing bubble and global financial crisis. Actually, very similar scenario. S&P 500 recovered and once again reached $1,500 a share. The main stimulation was behind this bull market is printing enormous amount of money and increasing interest rates. Interest rates went from 1.5% all the way to 5.5% in a matter of few years. As soon as the Fed realized that they were in a deep shit, they drastically started reducing interest rates while we enter into another bear market. S&P 500 once again dropped from $1,500 all the way to $750 a share. It basically halved once again while interest rates dropped from 5.5% to 0%. Let's take a look what happened to eurodollar. Just like in 2000s dot-com bubble, eurodollars was descending and it reached the bottom, which is indicated by this yellow arrow. Then it slightly increased and went to that tight trading range. Out of the sudden, on top of the market, eurodollar exploded, and it was the end of the bull market and the beginning of the new bear market. Let's take a look what eurodollar is doing today. In 2018, Fed once again raised interest rates, while we had some hiccups in volatility in the stock market. Then Fed postponed interest rates hike and eurodollar bottomed just like in the dot-com bubble and the housing bubble. It is indicated by this yellow arrow. Then eurodollar starts to rise, and it has been rising for the entire 2019 year. It looks like eurodollar is about to reach that final phase, tight trading range. The momentum can continue to go on for a few months or even a year. But what we know that as soon as we will see some major upward movement out of that tight trading range, it will be an indication of the end of the bull market and the beginning of the new bear market. Let's take a look at some other indicators that represent economic slowdown.
I talked to the brightest minds in the investment industry to find out the odds of recession and to determine how investors ought to position as a result. I explained why I was asking the question in the first place in a piece called Is Recession Coming? Let's pick it up where I'm taking a close look at ECRI, which is a weekly data series that I use to determine the economic strength of the business cycle. So you see the chart here of ECRI with quarterly GDP, and you can see how well correlated it is. It's indicating that we've got some weakness to come. Okay, so that's the first interesting point. Then I like to put the ECRI against a number of other indicators that may be forward-looking. And this is where it gets interesting. I'm going to show you a whole series of charts now for you to look at. So this chart is the CAS Freight Shipments Index. You can see how dramatically freight shipments have fallen and how much they're suggesting that the ECRI could fall from here and therefore the GDP as well. Car loadings, a similar way of looking at transportation, it's collapsing. Capital goods orders, these are the big ticket items, the things that a lot of times you use financing for or are involved in the global supply chains. You can see how they are rolling over as well and following ECRI lower. If you believe in this supply chain story, and it seems to be bearing itself out in the press almost daily, then you've got to imagine that capital goods orders are going to come lower. But households are also struggling with the rates. So you've seen that in how much car sales have fallen. So car sales have languished and they're expected to go further. Clothing sales have collapsed in recent months as well, which has been an extraordinary move. And restaurant sales as well have been extremely weak. So you're starting to see not only is shipping and moving goods around weak, but you're also seeing a weakness in the consumer and a weakness in business expenditure. Another great global indicator I've looked at is semiconductor sales. Semiconductor sales are extraordinarily weak right now, and they too are suggesting the global business cycle has a lot further to fall. Back in the US, we've also got the housing cycle. It looks like that the Case-Shiller House Index is starting to weaken significantly and is now at the weakest level since before the previous recession. And we also have weakness in house prices overall and construction. So I'm concerned that all parts of the economy are showing evidence of weakness. And I know many people say, well, unemployment's not. Unemployment's strong. Unemployment, interestingly enough, is the most lagging of all indicators. And just remember that every time the Fed cut rates and unemployment was below 4%, we went to a recession almost immediately afterwards. They're all lagging. So don't get trapped in the unemployment. Look at the forward-looking indicators, and they're looking problematic. So that's what I found in the US. Then I took a look at the global data and found even more signs for concern, particularly around Europe and China. That's how I determined that based on the data, the whole world looks to be rolling over at once. Now, some of you might be thinking, so what? It's about time we had a mild slowdown. But there are two major issues here, debt and demographics. It could lead to a massive adverse event that I refer to as the doom loop. I know it's dramatic, but here's my summary of the chain of events that we could see. Phase 1. The business cycle weakens, credit begins to widen, corporate cash flow worsens a tad, and shares fall and volatility increases. I think that's where we've got to now. I think phase 1, we accomplished, and it started really in about October. Phase 2, the business cycle weakens again, credit widens more, cash flow gets worse as do profits, tax receipts fall, and state pension funds stop buying debt. Big BBB stocks fall, and bonds fall even more sharply. Equities fall hard. So I think this is the next phase, and I think it's coming after the summer. We'll wait and see. My forward-looking indicators suggest that Europe has a SESI upcycle right now. There's a bit of stabilization of data. I have a feeling that if I'm right about the debt ceiling or the dollar breaks higher, then I think we're going to start to see phase 2 come in. When we start seeing phase 2, we know where this is going, because then the story becomes very clear. Phase 1 was the alarm bells. Phase 2 is strap yourselves in. Okay, let's go on to phase 3. This is when things get ugly. The baby boomers start to panic to get out of equities permanently. There's downgrades of triple B to junk. The EU banks can't take the funding stress, and the ECB and the government step in. Credit spreads explode. Credit seizes up entirely as pension funds have forced sellers on downgrades. Equities go into tailspin, there are no natural buyers. Credit widens dramatically, offered only, no bids. Junk bond market overwhelmed. Pension funds get into trouble, defaulting on obligations. Big, famous companies are being forced towards bankruptcy unnecessarily. That's the really ugly phase. And that's the one where I think many of us have got a sense that there is an end game that's at the end of all of this. If there is one, it lies in the heart of that. Whether we get there or not, it's going to be a function of what the Fed does and what the central banks do and how they deal with this. And there's many outcomes for that, and it is not going to be a straight battle. But all I do know is these things tend to accelerate much faster.
Another interesting chart is unemployment rate. But you may probably think, oh, what are you talking about? Unemployment rate is a new all-time low. Yes, it might be true, but guess when else unemployment rate was at very low levels? It was very low in 2000s prior to the dot-com bubble. And also it was very low in 2007 prior to the housing bubble and global financial crisis. If you would like to get your own eurodollar chart, click the Young Hostile link in the description box below. You will find eurodollar chart, 90% discount code, free ebook on trading, and much more. Let me know what do you guys think about potential recession. Leave your thoughts in the comment section below, hit that like button and subscribe